Howdy, Jacob here. Today we're looking at Fortinet, not Fortnite. Software industry, 50.7 billion enterprise value with 52.2 billion market cap. So more cash on hand than debt here. But the price to book is negative. So that is interesting. Maybe they've been buying back a lot of shares or something. Revenue growth is stupid. 770 million in 2014 up to 5.3 billion in 2023. Company was incorporated in 2000. We're talking about a very new company that's already $52 billion. Amazing. Margins both going up. Operating margin up way higher, 7.7% to 23%. And then gross margin from 70 to 77%. Return on invested capital, I can't even look at it. It looks a little crazy. But again, when you repurchase shares, these can be inflated, but even still, 40% in 2018 and 2020. Revenue growth numbers, the lowest revenue growth of the last 10 years was 17% year over year. Absolutely astounding. Can they keep that up? I'm going to be conservative and say they can't, but each their own. Like, if you do, that's absolutely fantastic for you. I'm just a little skeptical that a $50 billion company is going to be growing that substantially. So you do see shares going down, not as much as I thought they would, though, but it is due to the stock-based compensation also being $249 million. So, yes, they are repurchasing 1.5 million, at least in the last rolling 12. There are the use of cash, a little bit of reinvestments, a little bit of acquisitions, nothing really on debt, nothing really on dividends, which is dividend part is good, and debt, they have more cash in than debt. So, yeah, you don't need to be paying down that debt. You got enough cash, so just reinvest in yourself. Buy cheap shares. Are these cheap shares? 48. If this company can continue to grow at these 20%, they grow their revenue 20% for the next 10, 20 years. 48 on PE is cheap as all get out. But is that the case? I don't know. I'd be skeptical that they can repeat this growth going forward. So they provide cybersecurity and networking solutions worldwide. I do think cybersecurity is huge, but it's been huge, as you can see. So I might do 15% revenue growth. They'll still have humongous growth at the end of this period. Margins have been improving. Free cash flow is so much higher, but they are issuing shares so that stock-based compensation is included in that free cash flow. So we'll be, netting that out essentially with our share change here. But the net income margin, let's do 25, 30, and then buy back 1% of shares. So I'm saying they use 500 million to repurchase shares, and everything else they're just reinvesting, just increasing that growth, trying to efficientize this business and make it go crazy. And I don't think I'm being not conservative, but I wouldn't say that these are absolutely conservative numbers, and we're still looking about 30% off the price to buy. Again, fantastic company. I want to own it. I just need the right price to own it. And I'm just not feeling it like it for me at this moment. So, hopefully you enjoy the video, do it in conjunction with your own analysis, and have a fantastic rest of your day. Thank you.